Greetings, Dr. Chua, esteemed classmates, and viewers soaring with us today. I am Ladal Yasat, and I'm thrilled to accompany all of you for this fascinating journey into the financial skies of Cebu Air. But before we dive into the details, allow us to introduce ourselves. Once again, I am Ladal Yasat.
I am Christine P. Alili.
Who is that Mikael Arrogante?
And I am Jerry Claire Agosto.
Our presentation will follow a structured approach covering key aspects outlined in our table of contents. We'll begin with an exploration of Cebu Air's company background, financial highlights, financial outlook, financial ratio and evaluation, including a detailed financial ratio analysis, DuPont analysis, and lastly, our synthesis. In a world where financial winds can be turbulent, understanding how Cebu Air adjusts its financial strategies and navigates through challenges becomes crucial. To begin, let us first take a close look at the company's background. What is Cebu Air? Well, Cebu Air is more widely recognized as Cebu Pacific Air. It is a Philippine low-cost airline founded in 1988. It is the oldest low-cost carrier in Asia and the country's leading airline in terms of passengers. Cebu Air operates an extensive route network from 7 hubs, mainly operating from Ninoy Aquino International Airport. The carrier also conducts operations from secondary aviation bases spread across the country. They offer over 70 domestic routes and 22 international routes, totaling 2,694 scheduled flights on average per week. Moreover, Cebu Air captured a market share of 57% in 2022. Since establishment, the company has transported 200 million passengers. Specializing in scheduled air transportation and cargo services, the airline has a roster of 67 modern Airbuses to optimize connectivity across the Middle East, Australia, the US, and throughout the Asia-Pacific region. They also offer ancillary services, hotel booking, tour packages, car and crew services through partners. Moreover, on May 16, 2016, Cebu Air founded Value Alliance as a pioneering member. The first pan-regional LCC alliance comprises 8 airlines in the Asia-Pacific region for the purpose of expanding networks, reducing costs, and boosting traveler benefits. The alliance collectively covers more than 160 destinations and a passenger count of 47 million on average per year. So why choose Cebu Air? Studying Cebu Air aligns with the group's curiosity surrounding the status of airline industries and service companies, particularly during the pandemic. With widespread news about travel bans and extensive disruptions, delving into Cebu Air's situation allows the group to gain insights into how the aviation sector navigated such uncertain times. To discuss more on how Cebu Air came to be, let me pass the wheel to Christine Alali.
Thank you so much, Lada Marie. In the landscape of aviation, let's circle on and delve into the comprehensive journey of Cebu Pacific, tracing its evolution from its foundational years to its recent resurgent post the tumultuous period of the COVID-19 pandemic. Primarily, Cebu Pacific was founded in the period of 1988 and commenced operations in 1996. Cebu Pacific began its journey with 24 daily flights connecting Manila, Cebu, and Davao. While it was paused briefly due to an aircraft incident, the company continuously grew and ventured varying international routes. In the following year, the airline expanded its fleet and operational sites, heralding a period of exponential growth. The company launched exclusive routes from Cebu to Singapore and Hong Kong, asserting its dominance in these markets. By 2016, it became a founding member of the Value Alliance, a significant step in its commitment to a collaborative growth. During the COVID-19 pandemic, Cebu Pacific's operation was severely affected, as it resulted in a temporary suspension of flights and subsequent layoffs. Despite raising 40.5 billion for recovery in 2021, the airline faced challenges leading to continuous losses due to low passenger demand and increased operational costs. In the contemporary period, Cebu Pacific restored its pre-pandemic capacity, reinstating most international destinations and witnessing a surge in passengers. Despite post-pandemic challenges, including fuel price hikes and currency depreciation, the airline aims for a full workforce restoration by 2023 and focus on expanding operations to key destinations, particularly in China. With that, let's investigate the financial outlook of the company, starting from its financial position, declaring its total assets, liabilities, revenue, and expenses. First off, we can see here that Cebu Pacific Air has a consistent upward trend in its total assets and liabilities, from a 124.2 billion in 2020 to a 147.15 billion in 2022. The coupled increase in liabilities from 103 billion to 150 billion in 2022. This is alarming because while the increase in assets indicates continual investment and expansion in its operational capacity, this expansion has been paralleled by a noticeable rise in total liabilities, suggesting increased financial obligations and potential risk. Managing this balance between asset growth and liability management will be critical for the company's long-term financial stability. Moving on, the airline's revenue and expenses have been significantly impacted by the pandemic, leading to a substantial decline in gross revenue and expenses from 2020 to 2022. From 22.4 billion to 6.7 billion in revenue, while the gross expenses have also declined from 21.71 billion to 8.64 billion. The challenge remains in fortifying revenue streams to restore financial health. Cebu Pacific Air has experienced consecutive years of losses from 2020 to 2022, albeit with a diminishing trend, a net loss of 21.36 billion in 2020 and a net loss of 7.61 billion in 2022. It is essential to note that the financial figures we reviewed primarily cover the recent pandemic period. The recorded losses directly stem from the pandemic's impact on the airline's operations. The company's adeptness at managing these losses reflects resilience and a positive trajectory towards recovery. This saying all that, we look forward to viewing the company's cash flow directed to earnings or loss per share. From a loss per share of 35.68 in 2020, it reduces to 12.7 loss per share in 2022. In the graph, the company has displayed recovery negative amounts on the period. You can see the negative upward trend showcasing recovery despite challenging market conditions. Moving forward, strategies focused on restoring profitability, optimizing costs, and capitalizing increased travel demand will be instrumental in improving EPs and overall shareholder value. As we are currently on the time where moving away from the pandemic, the Cebu Pacific Air is forecasted to recover and go back to its glorious days.
Good day. Once again, I am Claire Agosto. I will be tackling a portion of Cebu Pacific Air's financial ratio and analysis. Cebu Air's financial ratio indicates a negative financial performance over the course of 3 years of business operations. To begin with, here is the analysis for the liquidity ratio of Cebu Pacific Air, which contains the current ratio and the solvency ratio of the business. As observed, the overall performance of Cebu Air in terms of its current ratio shows a poor standing. Cebu Air's current ratio displayed an upward trend climbing from 0.31 in 2020 to a promising 0.76 the following year. However, despite this growth, it regressed, dropping back to 0.68 in 2022, emphasizing an inconsistency in its ability to cover short-term debts. While the company's solvency ratio has shown a falling trend, suggesting a possible increase in financial risk. In 2020, Cebu Air had a solvency ratio of 1.21. This shows Cebu Air's ability to meet long-term financial obligations. However, in 2022 and 2021, the ratio dropped to 1.08 and 0.98 respectively. The drop in figures raises questions about the long-term health of the company's finances because this implies that its liabilities are growing faster than its assets. The successive declines in Cebu Air's solvency ratio may raise concern for investors and creditors due to the company's increasing strain on its ability to fulfill long-term obligations. For Cebu Air's financial leverage ratio, covering debt ratio, debt to equity ratio, and asset to equity ratio, the results show that the company is at an average standing in terms of its debt ratio, while it has a poor standing in both debt to equity ratio and asset to equity ratio. Cebu Air's debt ratio indicates that it is going through a rough path, as there is a significant increase in debt ratio from 0.83 in the year 2020 to 0.93 in 2021, increasing to 1.02 in the year 2022. This suggests that as the business progresses, an increasing portion of Cebu Air's total assets are being financed by debt, posing a risk to the company because it has more debt than it can manage. While its debt-to-equity ratio shows that Cebu Air was off to a good start in 2020 and 2021, as the amounts were significantly lower in comparison to 2022. However, there is a dip in Cebu Air's debt-to-equity ratio from 4.87 in 2020 to a negative 52 in 2022. Moving on its asset-to-equity ratio, in 2020, Cebu Air is in a moderate level of financial leverage at 5.87 in terms of its debt and equity. However, in 2021, the company's asset-to-equity ratio surged to 13.38, indicating that Cebu Air relies on debts to finance its assets. In 2022, Cebu Air is in a financial distress as the asset-to-equity ratio dipped to a negative 51, which could imply that the total stockholders' equity is negative, suggesting an imbalance in the company's financial structure. The company's profitability ratio, including gross profit margin, net profit margin, return on total assets, and return on common equity. In 2020, Cebu Air experienced a remarkable surge in its gross profit margin, soaring to 117%. However, in the years 2021 and 2022, the company's gross profit ratio is relatively low at negative 28% and negative 17%, expressing a loss of sales. This could mean Cebu Air's cost structure relative to its sales revenue is a significant challenge. For its net profit margin, it shows a negative result over the course of 3 years, which indicate the company's financial vulnerability, which could be a potential problem in attracting more investors. The company's ROA registered an adverse net loss amounting to 17% of its total assets, which persisted in 2021, indicating an 18% loss. However, in 2022, there is a marginal improvement of the company's ROA, which declined to negative 0.05. Finally, the company's return on equity ratio shows a dynamic picture with noticeable ups and downs. In 2020, the company faced a challenge showing a negative ROE of 1.01 and deteriorated to negative 2.35, suggesting a larger discrepancy between the net income and common equity. In 2022, there is a major shift in its return on equity ratio, bouncing back to 2.64, turning positive after a consecutive negative ROE, indicating that the company managed to generate net income surpassing its common equity during that year.
Air's PE ratio, we can see that they are not really doing well. This is a cause for concern for the company because it is negative values like these that drive investors away. Without investors, a business would suffer. All these negative values is the result of the losses the company has, and it has been this way for 3 years now. A negative PE ratio means that the company is not earning enough relative to its stock prices. During this time period, a lot of other businesses, small or large, were facing this problem as well. And it all boils down to one reason: COVID. The liquidity and solvency ratios of the company indicates an upward trend, but it is a small comfort considering that they are starting from losses. The company is still able to meet their short-term obligations, but these ratios are a sign that they are going to struggle with long-term commitments if they do not recover. In terms of debt, all these ratios show that they are covering their debt more using their equity rather than debt itself. This can be seen in their most recent total equity value, a negative amount, and is also seen in their debt to equity ratios. We know that COVID was unexpected, but now that we know that such things can happen, Cebu Air should up their strategy and risk management. Given their situation, I am sure that they did what they can to manage their debt and their losses, but it could still be done better next time, now that we have experienced the consequences of a pandemic. Now they should focus more on restoring investor confidence to ensure long-term financial sustainability. The DuPont analysis aims to examine the different factors that may influence the company's return on equity. And with a negative equity balance, Cebu Air just isn't attractive. We often associate high ratios with good, but when it comes to ROE, less is more. An ROE of 2.64 indicates that the company only generates 200th for every peso invested. That's like 2 pesos for every peso you invest. It isn't much.
So, let the spirit of Cebu Pacific Air's tagline, "Why Everyone Flies," echo and resonate with the promise of a bright future. As we conclude this financial flight, we look forward to witnessing Cebu Air ascend to new heights, making everyone's journey not just a flight, but an unforgettable experience. Thank you for joining us in this financial expedition. Safe travels and love the blue skies. Stay safe, everyone.